Okay, let's try to wrap our heads around this. Nano Dimension, they're in the 3D printing world, specifically this cutting edge area of additively manufactured electronics.
Right.
But here's the real kicker. The market is valuing them so low that their enterprise value is actually negative,
Mm-hmm.
less than zero.
And get this, their stock price is below the amount of cash they have sitting on the balance sheet.
It's pretty astonishing, really.
It makes you wonder, doesn't it? What does it say when the collective wisdom of the market thinks a company's fundamental operations are worth less than absolutely nothing?
That's precisely the puzzle we're tackling today. This really unusual situation with Nano Dimension, or NNDM, as of May 6, 2025, based on our recent fundamental analysis, it just throws up a fascinating challenge.
Yeah.
It really forces you to question why the market is so, well, profoundly skeptical of a company in what looks like a high-growth sector with potentially game-changing tech. What are we missing? Exactly. So for this deep dive, we've got our hands on a detailed fundamental analysis of Nano Dimension. And our mission is, look beyond the daily market noise.
Cut through it.
Yeah, understand the nuts and bolts of their business, what they actually do, the real obstacles they're facing, and, well, if there's a genuine value opportunity lurking beneath the surface. Forget the quick trades. We're going deep to understand the core story here.
And for you, the learner, our goal is to navigate this complex picture and really extract what truly matters. We aim to provide a clear and structured understanding of Nano Dimension, highlighting the key insights without, overwhelming you with jargon or unnecessary details.
Think of us as your guides through this potentially intriguing, maybe even confusing situation.
Let's dive in.
Let's jump into Chapter 1, Business Understanding. Now, at its core, Nano Dimension is an additive manufacturing company, but they're not making, little plastic figures or anything.
No, definitely not.
Their primary focus is on designing, manufacturing, and selling these 3D printing systems geared towards additively manufactured electronics, or AME.
So think 3D printing, circuit boards, antennas, that sort of thing, directly.
Exactly. And what's also significant is that through, a lot of recent acquisitions, they've expanded into broader additive manufacturing technologies and even SMT.
Surface mount technology, that's the more traditional way of putting components onto circuit boards. So kind of related, but different.
Right. And a crucial part of their business model, or what they hope will be crucial, is the recurring revenue they get from selling the specialized materials, the conductive inks, polymers, all the consumables these advanced printers need.
That consumable stream is key for a long-term value in this kind of hardware business, isn't it?
Absolutely. But the crucial point to note here, I think, is the strategic direction we've seen under the recent leadership changes.
Oh, definitely. First with interim CEO Julian Letterman, and now with the current CEO, Ofer Baharov, there's a very clear stated emphasis on tightening the purse strings.
Financial discipline, ROI.
Yeah, ensuring that any investments they make actually generate a tangible return, and really focusing on delivering value for shareholders. That's the message, anyway.
And they've also made a pretty decisive move, it seems, to concentrate their efforts on the AME side, their original tech and the SMT capabilities they got from acquiring SMTech.
Yeah, that narrowing of focus is a significant departure from, let's say, the previous acquire everything strategy.
Feels like it. So when we talk about their actual offerings, the Dragonfly series is their flagship for AME. These machines let you print complex electronic prototypes, maybe even some end-use parts.
And they have these specialized inks like high PED, that's high-performance embedded devices, which is where AME can really shine, embedding components inside the structure.
Right, and Agsite, their silver nanoparticle ink, they even have the LDM model, which is designed for, 247 production.
Then on the SMT front, that SMTech acquisition brought in a whole suite of equipment used in electronics assembly. Pick-and-place machines.
The ones that precisely position tiny components.
Exactly. Dispensing systems for solder paste and adhesives, the software to run it all, and even the reflow ovens to bake the boards. It's a whole SMT production line, potentially.
Now, things get really interesting, maybe complicated, with the recent additions of Desktop Metal and Markforged.
Huge acquisitions. Very different technologies, too.
Totally. This brought in a whole new range of additive manufacturing, metal binder jetting, sand binder jetting from Desktop Metal, composite 3D printing, more metal printing from Markforged.
Bound metal deposition, DLPSLA resins. It's a lot of different tech under one roof now.
The big question mark, of course, is how effectively they'll integrate all these, disparate technologies. They also offer a direct printing service called Nanos if you just need parts made without buying a machine.
Yeah, the sheer scope of technologies now housed under Nano Dimension is, as you said, both a potential strength, this huge portfolio, and a considerable hurdle.
Integration is key.
Absolutely critical. Successfully integrating the diverse offerings from Desktop Metal and Markforged. That's the make-or-break task, I think. We've already seen them make some tough choices, discontinuing certain acquired product lines like Adamatech and Fabrica to really laser in on that core AME and SMT focus.
Which suggests they know it's a challenge, right? A recognition of the integration difficulties and maybe a commitment to streamlining?
Don't hope so.
Right. So who are the customers for all this advanced tech? They boast over 2,000 customers. And these aren't hobbyists playing around in their garages.
No, these are serious players.
We're talking major players in aerospace and defense, like L3 Harris and Hensoldt, big names in automotive, industrial manufacturers, medical device companies.
And a lot of R&D labs and universities, too.
Yeah.
University of Stuttgart, Northeastern University are examples they give, places pushing the boundaries.
Yet, despite this impressive-sounding customer base, Nano Dimension is still a small-cap stock. Market capitalization hovering around, what, $350 to $355 million?
Roughly, yeah. Which brings us back to that head-scratcher.
That negative enterprise value. Deeply negative, ranging from approximately negative $392 million to negative $418 million.
Meaning the market values their debt and cash more than their entire operating business. It's bizarre.
And of course, the stock price has just plummeted since the highs of early 2021. This really highlights the market's current, well, profound lack of faith in their ability to generate value.
That negative enterprise value is such a powerful indicator of deep-seated skepticism. It essentially suggests that investors place a higher value on their cash pile than on the actual business itself.
Believing the business is actually destroying value.
That's the implication, yes.
Yeah.
The massive stock drop since 2021 just underscores that erosion of confidence.
So what's the fundamental appeal then? Why would a company choose this AME tech over traditional methods?
Well, they emphasize speed and flexibility, rapid prototyping, faster turnarounds for custom electronics. That's a big one.
Okay.
Then there's IP security, keeping sensitive designs in-house instead of sending them out. Crucial for defense, for example.
Makes sense, and they push the environmental angle pretty hard, too.
Yes. They claim significant advantages, like up to 82% less chemical use, 98% less raw material waste, 57% less energy, 99% less waste overall compared to traditional PCB manufacturing.
Those are big numbers. If true.
If true and if scalable, yes. Plus, there's the design freedom, creating complex 3D shapes, miniaturizing things, and, increasingly important, supply chain resilience, making things locally.
That last one feels very relevant right now.
Extremely. The value propositions you've listed, speed, IP security, sustainability, design flexibility, and supply chain resilience, they're increasingly important. The environmental benefits, especially as ESG becomes more of a focus.
But the critical question remains.
Can they translate these compelling theoretical advantages into widespread commercial adoption and, crucially, profitability? That's the billion-dollar question. Or in this case, maybe the negative $400 million question.
Ah, right. So to answer that core question for this first chapter, what does Nano Dimension actually do and how do they make money?
In simple terms, they develop and sell advanced 3D printing systems and the special materials for them, with a new strategic focus on additively manufactured electronics, AME, and surface mount technology, SMT.
And revenue comes from selling the machines initially.
And then ideally, a steady stream from selling those proprietary consumables, inks, pastes, etc. The expanded portfolio from DM and Markforged could broaden this, but...
That's still a potential, maybe, if they integrate its story.
Exactly. That strategic pivot towards AME and SMT, combined with the potential and the challenge of the acquired tech, represents a huge evolution. And that recurring revenue from materials, it has to become significant for long-term stability.
Which means they need to sell more printers. A lot more.
Precisely. It all connects.
All right, let's move on to Chapter 2, Management Evaluation. This has definitely been a dynamic area for Nano Dimension. Let's look at the recent track record.
Understatement of the year, perhaps.
Maybe. U.F. Stern was CEO from 2020 until late 2024. His time saw, well, massive capital raising.
Billions raised when the stock was high.
A rapid-fire series of acquisitions, and that very public, hostile takeover attempt of Stratasys.
Which failed and cost a lot.
Right. But this period also saw the stock price collapse, ongoing losses, those very public, very messy fights with activist shareholders.
Murchison says
Yeah, and critical reports from proxy advisors like ISS and Glass Lewis questioning governance.
So a very eventful, arguably turbulent tenure.
Then Julian Letterman stepped in as interim CEO. His message seemed to be more about financial discipline.
A shift in tone, definitely.
And now, since April 2025, Afur Baharov is the CEO. He was chairman before, has experience from Stratasys, actually, and is really hammering this message of a streamlined strategy around AME and SMT, cost cuts, and integrating those huge acquisitions.
Plus, we have a new chairman, Robert Pons, and a new CFO, Asaf Zipori, who came over from Markforged, one of the acquired companies.
So the average tenure of the current top team is, what, less than a year?
Barely. It signals massive change, transition, maybe instability depending on your view.
The contrast in leadership styles is pretty stark, isn't it? Stern's aggressive growth and risk-taking versus what seems to be a focus now on fiscal responsibility and shareholder value.
Seems to be, yes. The proof will be in the pudding, of course.
Yeah.
But that very short average tenure really highlights the recent upheaval and the absolute need for stability and consistent execution now.
And how have they handled crises? The Murchison activist campaign was a big one.
Huge, very public fight.
Stern's initial reaction was quite confrontational, fighting back hard.
Whereas the new leadership took a more pragmatic approach, ultimately leading to board changes demanded by the activists.
Settling, essentially. Then there's the whole Desktop Metal merger saga. That was messy, too.
Oh, yeah. Trying to terminate the deal after it was signed.
Right, then being forced by a court to close it. And now the focus is on integrating a company, Desktop Metal, that has its own significant financial challenges. They're doing a strategic review of DM's finances now.
That history of crisis response definitely shows an evolving philosophy. The combative approach seems gone, replaced by something more measured. But the Desktop Metal situation, that's a huge ongoing challenge. It'll be a key test of their ability to handle complex, maybe even distressed situations.
What about communication, transparency with investors?
Historically, that was a major criticism. Lack of clarity, especially around the rationale for all those acquisitions under Stern, and the overall financial picture wasn't always clear.
But recently, under Letterman and now Aharov, there seems to be a conscious effort to be more transparent, more focus on financial metrics.
They're saying the right things, yes. More focus on adjusted EBITDA, cash flow, the path to profitability. But the real test is sustained transparency, especially on how these complex integrations are actually going and the combined company's performance. Talk is cheap.
Absolutely. Transparency is vital for rebuilding trust, which they desperately need to do. Consistent, candid updates are crucial.
Especially on the Desktop Metal integration and financials. That's the elephant in the room.
And their ethical reputation. Well, that definitely took some hits. Past governance issues were significant.
The poison pill, the classified board, where directors had staggered terms, making it hard to change the board quickly, disputes over shareholder rights.
Standard anti-takeover, entrenched management stuff that activists hate.
Exactly. But we are seeing positive shifts now, driven by that activism. A reconstituted board, the poison pill is gone, proposals to declassify the board.
So moving towards more standard shareholder-friendly practices.
Yes. But the memory of those past issues lingers. They need sustained commitment to good governance to fully restore trust.
So when we ask ourselves, is the current management honest, capable, and shareholder-oriented?
It's a nuanced answer, isn't it?
I think so. The new leadership says they're committed to these principles. Their initial actions, like settling with Murchison and focusing on financials, seem encouraging.
But their capability to execute this incredibly complex turnaround, integrate these massive, potentially problematic acquisitions like Desktop Metal, and ultimately rebuild market trust, that remains unproven.
It's still very much a show-me story. Don't tell me. Show me the result.
Precisely. Intentions seem good, maybe, but success will be judged purely on results, sustainable profitability, and generating real returns from these expensive acquisitions.
Okay, let's dive into the numbers. Chapter 3, Financial Health. Market cap, we said, $355 million.
But that enterprise value, way down at negative $392 to $418 million, still blows my mind.
Revenue for the trailing 12 months, about $57.8 million, showed a modest growth, 3% year over year in fiscal 24, though preliminary Q1 25 numbers suggested maybe 8% growth.
A slight uptick, maybe. Gross margin for 24 was 43%, but it dipped quite a bit in Q4, down to 33%. That's not great.
And critically, operating and net margins.
Still deeply negative, bleeding cash on operations.
Earnings per share for 2024, negative $0 or 44 cents. Price-to-book ratio around 0.41, which is low, reflecting that market skepticism again.
But then you look at the balance sheet specifics.
Right. Nano Dimension standalone has very little debt, debt to equity around 0.01.
And their current ratio measuring short-term liquidity is sky high, like 25.6.
Because they are sitting on a mountain of cash and equivalents, around $840 million as of the end of March 2025.
Which is just,
Yeah.
yeah. But we do need to remember the debt that came with Desktop Metal. NNDM's direct debt is minimal, but the consolidated picture is different.
Good point. Their net cash per share is about $3.46, which, again, is higher than the actual stock price currently.
The market is literally saying the cash is worth more than the company holding it.
And finally, free cash flow for the last 12 months, negative $59.2 million.
So they are burning through that cash pile at a decent clip,
Yeah.
not sustainable indefinitely.
It really is a tale of two sides, isn't it? On one hand, a super strong balance sheet, tons of cash, minimal standalone debt.
Fortress balance sheet almost.
But on the other hand, persistent, deep unprofitability across all key metrics and significant negative free cash flow.
That fundamental disconnect is the key driver of the market's skepticism, I think.
So, are they profitable with a strong balance sheet? No. Definitely not profitable. Yes, strong balance sheet because of the cash, but that cash burn offsets some of the comfort that brings.
Exactly. Now, thinking about stability, they have a long history, 5-10 years, of negative earnings.
Yeah.
The amount of loss has fluctuated, but it's consistently red ink.
They've never paid dividends, no history there.
Not surprising for a company focused on growth and R&D and, well, not making profits.
Their debt management before Desktop Metal was conservative, but that $115 million in convertible notes acquired with DM changes the game, adds risk.
Definitely adds financial risk and complexity. And looking at working capital efficiency, yes, high liquidity ratios mean they can pay near-term bills easily. Low inventory and asset turnover ratios suggest they might not be using their assets very efficiently to actually generate sales. Operational inefficiency, perhaps.
Their Piotrowski F-score, which tries to measure financial strength, comes in at a mediocre 4 out of 9. So not great, not terrible.
The consistent negative earnings trend really hammers home the core challenge: achieving sustainable profitability, monetizing the tech. The conservative debt approach was a strength, but the DM debt adds a new wrinkle. And those low turnover ratios, they raise questions about operational efficiency.
So are earnings volatile, and do they have excessive debt? Well, earnings are consistently negative, so maybe predictable in their negativity. But the size of the loss varies?
Volatile in magnitude, maybe.
Standalone NNDM didn't have excessive debt, but the consolidated company now carries a significant debt burden because of Desktop Metal.
We have to look at the combined entity now.
Let's just quickly glance back, historically, 2017 to 2024. Revenue has generally trended up, especially boosted by acquisitions in 22 and 23.
But gross and net margins, consistently weak or negative, resulting in net losses year after year, negative EPS.
They built up that huge cash balance, mostly through stock issuance when the price was high. Standalone debt stayed low until DM came along.
It paints that picture clearly. Growth, often via M&A, but a persistent struggle to make it profitable.
That cash pile is the defining feature, but also the source of scrutiny. How are they using it? Are they just burning it?
Which leads us nicely into the second half.
Okay, we've covered a lot of ground in the first half, the business, the management, the financials. Now let's shift gears and delve into the second half, starting with Chapter 4, Market Sentiment.
And the prevailing market sentiment surrounding Nano Dimension is, let's just say, overwhelmingly negative.
You think? Trading below cash, negative enterprise value.
Yeah, it strongly suggests a deep, deep level of skepticism among investors. It's also seen as highly volatile. The beta is around 1.7, meaning it moves more dramatically than the overall market.
Probably fueled by that history of activist fights, the constant M&A drama.
Absolutely. It's viewed as highly speculative right now.
And when we look at analyst price targets, well, there aren't many current ones from major firms.
Coverage is pretty sparse. Right? It isn't usually a great sign.
Historical ratings from late 2023, early 2024 were mostly hold, with price targets higher than today. But that was before the big acquisitions closed and, well, before the continued stock decline.
Fintel does show one really optimistic outlier target, way up at $10.20.
Wow, that's ambitious given the current price below $3.
Seems like an anomaly. Most algorithmic ratings are more neutral or even lean towards sell. That lack of mainstream coverage is definitely a negative signal for many investors.
Reflects the uncertainty, I guess, and news events They definitely move this stock.
Hugely sensitive. M&A announcements, especially the Desktop Metal drama, the court ruling forcing the closure, caused a sell-off, for instance.
And the Markforged acquisition initially seemed positive, maybe?
A bit, yeah. Leadership changes, strategic shifts like the share buyback announcement that got a positive bloop, and of course, financial results move it.
So the narratives driving sentiment right now are all about this transformation attempt and whether they can actually pull off these integrations.
Exactly. The market is hypersensitive to any news offering clues about the turnaround progress, especially with Desktop Metal and Markforged. Successful integration is seen as the absolute pivot point for sentiment.
Okay, let's look at the betting crowd, short interest and options activity.
Well, the short interest people betting the price will fall has come down from its peak, but it's still pretty significant. We're talking over 11 million shares shorted as of mid-April 2025.
And the days to cover, how long it would take shorts to buy back shares.
Figures vary a bit, depending on the source, maybe 4 days, maybe closer to 9. Either way, it suggests a meaningful number of investors are still betting against NNDM.
And the options market, expecting fireworks.
Implied volatility is definitely elevated, around 62%, which is in the 84th percentile, meaning options are pricing in much bigger future price swings than usual for the stock.
So overall, short interest and options activity still lean bearish and expect continued volatility.
Yep, underscores the speculative nature. Lots of people think it could go down further, and the options market expects big moves up or down.
All right, moving on to Chapter 5. Ownership structure. Who actually owns this company?
Institutional ownership looks fairly significant. Reports vary, but maybe somewhere between 24.5% and 38% of the shares.
And notably, there's a strong presence of hedge funds. Anson, Murchison, the activist, Boothbay, Clearline.
And we saw ARK Investment Management, Cathie Wood's firm, significantly cut their stake. That got some attention.
Interesting, though, some recent data, like from Fintel, suggests an increase in both the number of institutional owners and the total shares they hold.
That's curious. The presence of those hedge funds, especially activists like Murchison and Anson, suggests a chunk of that institutional money believes there's value to be unlocked or changes to be forced. ARK backing away is also a data point to consider.
What about the insiders? Management and board, do they have much skin in the game?
Seems relatively low. Reports put insider ownership between maybe 2.5% and 3.2%.
That's not a lot.
And tracking their trades is harder because Nano Dimension is a foreign private issuer. They're exempt from some SEC reporting rules, like the Section 16 filings that show detailed insider buys and sells for U.S. companies.
So it's harder to see if insiders are buying or selling with conviction.
Exactly. That limited skin in the game and lack of transparency on trades could be a concern for investors who like seeing management heavily invested alongside them.
Okay, so ownership overall is quite dispersed then.
Seems so. Retail investors hold a big chunk. Estimates are 54% to maybe 59%. No single majority owner.
But those large institutions, especially the activists, can still wield significant influence.
Definitely. Anson and Murchison have proven they can push for changes.
And corporate governance. We touched on this. Definitely a sore spot historically.
Yeah, under Stern. Classified board, poison pill, shareholder rights disputes, all the stuff that makes governance watchdogs wary.
But Murchison's successful campaign forced changes. Board overhaul, poison pill expired, proposals to declassify the board.
Big improvements on paper, moving towards more shareholder-friendly practices. Though it's still worth noting, the CEO is also the chairman.
Which some governance purists don't love, preferring separation of those roles.
Right, so governance impacted ownership and strategy, and the recent changes are positive steps, but maybe not perfect yet in everyone's eyes.
Let's shift to Chapter 6, Risk Assessment. Let's use the SWOT framework: strengths, weaknesses, opportunities, threats. What are NNDM's key strengths?
Okay, strengths. They definitely have proprietary, innovative AME technology. That's core.
The massive cash balance is obviously a strength.
Huge strength, provides runway.
Yeah.
Renewed strategic focus, supposedly more discipline now.
The potential, at least, for an expanded portfolio and a greater scale after all the M&A.
And they operate in markets that align with big trends: reshoring, supply chain diversification, advanced manufacturing.
See solid potential there. But the weaknesses are just as stark.
Oh, yeah. Chronic, persistent unprofitability is number one.
The massive integration risk from the M&A, especially Desktop Metal with its own financial woes.
Huge risk. Management and board instability given all the recent changes.
Damaged credibility with investors after the stock collapse and governance fights.
And importantly, stagnant organic growth. Revenue growth has largely come from buying other companies.
Right. These weaknesses highlight the massive execution challenges ahead. Profitability, integration, major hurdles.
Absolutely. Now, opportunities.
The overall additive manufacturing market is large and growing. That's a tailwind.
They have the potential maybe to be a leader in market consolidation if they can successfully integrate what they've bought and maybe do more strategic deals.
Synergies and cross-selling opportunities between NNDM, SMTech, DM, Markforged, if they can realize them.
The reshoring and supply chain diversification trends we mentioned that could drive real demand.
And just continued technological advancement in the field, new materials, faster printing, etc.
So the external environment offers opportunities if they can execute internally.
But then the threats, also significant.
Intense competition. Lots of players in AM and electronics manufacturing.
Macroeconomic headwinds, recession fears. Higher interest rates impacting capital spending by their potential customers.
The very real threat of M&A integration failure, especially with Desktop Metal. If that goes badly, it could sink the ship.
Continued cash burn, raising questions about long-term financial viability if they don't turn profitable.
Technological obsolescence, can they keep their tech edge against fast-moving competitors?
And regulatory or trade policy risks, like those tariffs we need to discuss.
Right. These threats underscore the external pressures. Fierce competition, macro risks, and that integration risk looms large.
Let's touch on those 2025 U.S. tariffs specifically. Broad tariffs, high rates on Chinese 3D printers, potential future tariffs on electronics components.
Yeah, for the AM and electronics industries generally, this could mean higher import costs, supply chain headaches.
But maybe also an incentive to reshore, produce more locally.
Potentially. For Nano Dimension specifically, it seems like a mixed bag. Well, they might face higher costs for some components if they source from affected regions. Need to know their supply chain details.
But
They could also see increased demand as companies do look to build more resilient domestic supply chains using technologies like theirs, and acquiring U.S.-based DM and Markforged might actually position them well strategically.
so it could help or hurt.
Pretty much a double-edged sword. Depends on their specific exposure and their ability to capitalize on demand shifts while managing everything else, especially the integrations.
Okay, Chapter 7. Brief conclusion then.
Yeah.
So, summarizing.
Yep.
We have a company with genuinely cool, innovative tech in AME,
Potential game-changer tech.
but struggling mightily to turn that innovation into actual profits.
So you have that fortress balance sheet due to the huge cash reserve.
But they're burning through it at a pretty good clip. Negative free cash flow.
New management team trying a very complex turnaround, heavily reliant on integrating these massive, arguably troubled acquisitions.
And the market is just deeply, deeply skeptical. Negative enterprise value, stock below cash says it all.
Right. We've covered a lot today, hopefully giving you, the learner, a clearer picture of the dynamics here without getting lost in the weeds.
And that really brings us to our final thought, the core tension here.
Yeah, that significant gap we keep mentioning. The technological promise versus the harsh financial reality. This new management is making a high-stakes bet on M&A integration to bridge that gap, but the outcome is far from certain.
So this deep dive leaves us pondering this. In the high-stakes world of technological disruption, is it ultimately better to have a truly groundbreaking invention burdened by uncertain financial footing?
Like Nano Dimension, perhaps.
Or is it better to have a more stable, maybe less exciting business model that's still waiting for its own disruptive aha moment?
That's a critical question, isn't it? Especially when evaluating companies in these emerging tech spaces. How do you weigh that potential for transformation against the cold, hard need for a viable, profitable business?
Food for thought. For more in-depth analyses of fascinating situations like this one, be sure to subscribe to the Stock Analytics AI YouTube channel.
And finally, just a reminder, this deep dive was based on our review of publicly available information as of May 6th, 2025. It's absolutely not financial advice. Do your own research.
And please also note that artificial intelligence was used as a tool in the analysis process that informed our discussion today.